Hello friends, welcome to the course on Essentials of Financial Management. Here we are in the process of dealing with the techniques which are helpful to a finance manager to evaluate the long term investment proposals, and in this series we have done the conceptual framework of capital budgeting techniques and average rate of return, payback period method, discounted payback period method of the techniques which can be used for deciding whether to select a project or not to select a project. In this process, today we shall be dealing with the discounted appraisal techniques for risk free projects, and within this we shall discuss two very important techniques. Number one, the net present value method, and second one is profitability index method. But before we shall start the discussion on NPV and PI, let us see what are these so important features, what are the important feature which makes the discounted appraisal techniques a very significant tool to evaluate the long term investment proposals or the capital budgeting proposals. Here, because of the two reasons: number one, it is considering the time value of money principle, it is important, and secondly, with the help of this principle, it is going to discount the future cash flows to its present value. And here these three techniques will be discussed under the discounted appraisal techniques. Number one, net present value, second, profitability index, and in the subsequent lecture the discussion would be devoted to the internal rate of return method. What is net present value method? It is also known the value of the project. It is also known as the wealth generated for the shareholders. It is computed by finding out the difference between present value of all streams of future cash inflows and the investment outlays to generate these cash flow. That means, here we got two important variables. Number one, what is the investment outlay that a project demands? Secondly, what is the stream of cash inflows being generated from the project in subsequent years, and later on the future cash flows are converted to its present value. Then it is compared to the present value of cash outflow, and it is found out whether the cash flows are more than the cash outflows or vice versa, and if the present value of cash inflows are greater than the cash outflows, project is considered to be viable and hence it would be selected. Then there is a formula for calculating the net present value of a project. So, here we can see net present value is equal to the summation of all cash inflows generated from the project over a period of time discounted by the present value factor or the cost of capital. Then from this we deduct the initial investment outlay. So, if this difference is positive, we can say that the project has generated positive net present value, and hence it should be considered, it should be selected by the management. Here in the formula we can see the E represent, the numerator present the cash inflow, or this can also be the cash outflow. The T is the time period in which the cash flows are being generated, and K is nothing but the cost of capital which is used for discounting the future cash flows. There are certain steps which a firm has to follow if it is going to consider net present value method as a technique for evaluating the project. So, number one is company has to select the minimum acceptable hurdle rate of return. And what is minimum acceptable hurdle rate of return? Let me tell you, a company has to finance the project from outside or from inside, and if it is getting fund from outside to finance a project, it would be paying a rate of interest or rate of dividend to the supplier of fund. So, this rate of interest or rate of dividend is nothing but the cost of capital for financing the project, and if this cost of capital is lesser than the future expected rate of return from the project, then only the project would be selected. If the rate of return is more than the cost of capital, if the rate of return is less than the cost of capital, naturally it means that I have not done justice with the fund and their supplier. Anything which is more than the cost of capital should be appreciated by the management and should be selected from the board of director. Now, the second step is determination of the net investment outlay of the project. It is the total of the commitment of fund in order to invest in a proposal, and we have seen in the very first lecture that the investment outlay will include the cost of machine, installation cost. If there is going to be some additional working capital requirement, it should also come within the purview of initial investment outlay. The third steps suggest to calculate the expected stream of net cash flows. Then these stream of net cash inflows are converted to their present value, that means discounting will be done, and finally comparison of the present value of net cash inflows with the present value of investment outlay would be done to take a final decision. If the result is positive, that means if the NPV is positive, project should be accepted. If it is negative, project should not be considered because it is incurring a loss to the firm. Let us look at the practical questions on the net present value. Here ABC Limited is contemplating the purchase of a machine, and machine A and B, it is available at a price of rupees 1,20,000. That means the cost of machine is 1,20,000. The company is using discount rate of 8% for the project, and the earning after taxation and before depreciations are exempted to be as follows. So, machine A is giving 30,000, 40,000, 40,000, 30,000 and 20,000 in 5 years, whereas machine B is generating 20,000, 50,000, 40,000, 40,000 and 10,000 over the next 5 years. Now, the decision has to be taken as which machine is more profitable, and this decision would be based on the net present value method. Again, we have to convert the future cash inflows to their present value using the two important things. Number one, the year in which the cash flow has been generated, and what is the rate of interest or what is the cost of capital. So, again we will be using this particular part of the PV table, where cost of capital is 8% and project is giving the return over a period of 5 years. Let us calculate the present value of future cash inflows and we will find out what is the NPV. So, if we see the PV factor at 8% comes out to be 0.926, 0.857 and so on. Machine A is generating 30,000 and machine B is generating 20,000 in the first year. So, if we multiply the PV factor with the cash flows, we would be able to find out the present value of the cash inflows from machine A and from machine B. So, if we add it to if we add the present value of cash inflows over the 5 years, we can see that 1,31,260 is the total value received from the project A, and the project B on the other hand is giving us 1,29,340, and we know that the initial outlay is same for both the project, that is 1,20,000. So, now the last step is left where we have to calculate the NPV from machine A and machine B. So, if we deduct 1,20,000, that is the initial investment, from 1,31,260, we see that NPV is 11,260, that is a positive figure. So, machine A seems to be a profitable venture and machine B is also giving us a positive NPV, that is 9,340. So, if the management has a choice to select both the projects, it would be selecting both the projects given that the fund is available with the company. But if it is a mutually exclusive decision, then I hope you can also give us the answer whether project A or B. definitely it is project A which is more profitable as compared to project B. So, this was the problem which has very well highlighted how the NPV can be calculated using the NIO and NCB, and it can also give us the foolproof suggestion as which project is a better project. There is another problem based on the net present value method, when company is already having a machine, but it wants to replace the old machine with the new one. This process a bit more complicated as compared to the previous one. Let us look at the problem and its solution. The company is having a machine whose original cost was 15,000. Machine is 5-year-old, that means company has already used this machine for 5 years, and which can be sold out in the market for rupees 2,000, that is known as the salvage value of the machine, and the asset would be depreciated over a period of 15 years, making salvage value as 0. Depreciation is being charged on a straight line method, and tax rate applicable to this company is 50%. Now, the management is going to take a decision to replace this old asset with a new one whose cost is rupees 12,000, estimated salvage value is 2,000, expected saving if the new machine is employed by the company is rupees 3,000 per year. Depreciation is again being charged on a straight line method over the next 10 years, that is the life of the machine. Cost of capital for the firm is 10%. Now, the decision has to be taken whether it is worth replacing the old machine with the new machine, or management should continue with the old machine. So, we should have to do some workings regarding the depreciation, the capital loss, and the taxes which would be incurring on the capital loss being suffered by the company. So, let us find out how the depreciation is done. Depreciation formula says the cost of machine minus salvage value divided by the life of machine in year, that gives us the depreciation amount to be charged every year by the manager. Yearly depreciation on old machine can be calculated as 15,000, that is the cost of machine, minus 0, that is the salvage value, divided by 15, that is the economic life of the machine. So, we get 1,000 as the amount of depreciation to be charged every year for the machine. Current book value of the machine after 5 years comes out to be 15,000 minus 5,000, that is the depreciation that company has already charged for 5 years, gives us the current book value of the machine as 10,000. Current salvage value is 2,000, like if the machine is being sold out in the market, it can expect to get 2,000, and since book value is 10,000, market value is 2,000. So, there is a capital loss of 8,000. What is capital loss and how we have calculated? It is because of the fact that the books of the account is still showing as 10,000 as the price of the machine, but the market value is only 2,000. So, that means there is a gap of 8,000 which can be termed as a capital loss by the company. So, let us look at the working how the NPV would be calculated. So, NIO would be calculated by utilizing the same process. Cost of new machinery 10,000 less salvage value of old machine, that is 2,000. Why we are deducting? Because this is the cash inflow which is being generated by selling out the old machine. So, that is to be deducted if I have to consider the net investment outlay. Then there will be a tax saving on capital loss, that is 50% is the tax rate on 8,000, total 4,000 is the tax saving. Why we are deducting it? Because that is going to be an inflow in principle from the process. So, total cash investment outlay is 10,000 minus 2,000 minus 4,000, and total is here 4,000 as the investment required if the company is going to replace the old machine with the new one. Now, let us find out the another set of variables. which is known as the net cash inflows after tax. So, annual cash saving is 3000, depreciation on new machine is 12,000 minus 2,000, that is a salvage value from the machine divided by the life of the machine, that is 10 years. So, here we get 1,000 as the amount of depreciation to be charged every year. There will be tax on saving. So, 50% of 2,000 is rupees 1,000, which will be paid by the company, and that is how we are deducting this 1,000. Then depreciation being the non-cash expenditure, and a figure which represents the cash inflow, not the outflow, would be added back. So, here we get the net cash saving as 2,000 for next 10 years. Now, if we multiply the 2,000, that is the present value of 10 years saving, we get 12,290 as the total benefit received over the next 10 years. Where from we get this 6.145? Like if the company's cost of capital is 10% and the company is incurring an annual saving of 2,000 every year for next 10 years, then this PV factor of every year would be added up, and that is how we get 6.145. Since the annual cash saving is evenly distributed over the next 10 years, we can use the 6.145 to multiply with 2,000, and here we have got the present value of net cash benefit available to the company for next 10 years. Then there is a salvage value that will be available in the company in the 10th year when the machine would be sold out in the market. So, for this the PV factor in the 10th year will be 0.386. So, present value of 2,000 will be only 772. So, total present value of cash earning is 13,062. How to calculate the NPV? Now, we have to see the difference between the total present value of net cash saving and the net investment outlay. So, net investment outlay was 4,000, present value of cash saving is 13,062. We get again a positive figure of NPV as 9,062. So, this is the method when company is contemplating to replace an old asset with a new one. What is the answer, whether the project should be accepted or rejected? Here the answer is very simple. Since NPV is a positive figure, the project would be selected by the manager. I hope the simple method where we were using the NPV and the complex phenomena where an old asset was being replaced with a new one have been understood by you, and you do not have any problem if you are asked to calculate the NPV of any project and guide the management whether they should go in favor of the project or they should reject the project. As far as the merit of net present value is considered, it is a discounted cash flow techniques. That means, it is considering the principle of time value of money and do not consider the future value of cash flow equal to the present value of cash inflows. So, that means, it can differentiate between a money received today and tomorrow on only when it is discounting the future cash flow to its present value. It is finding it meaningful to compare the investment outlay and the future benefits. It is also very simple if we compare this with the another method which is known as the internal rate of return method, and if we are using the NPV method, it is going to do justice with the shareholders objective, and that is maximizing the value of the firm and maximizing the value of each share, thereby value of the firm. Now, the demerit of net present value lies in the fact that here we are using one concept, that is the cost of capital, and this cost of capital is used in order to convert the future cash flow to its present value. Where from this cost of capital is coming, and will it remain constant over a period of time? It is not so. Here the cost of capital is the benchmark which is available and which can be calculated taking into account the cost of individual funds which company is using for financing the projects. So, even the pattern of financing will change, the cost of capital will automatically change, but this factor is not considered under the net present value method, and hence the use of net present value method is subject to some kind of subjectivity, some kind of phenomena where the cost of a capital can not be taken in the same way for a period ranging from 1 to 10, from 1 to 15 years. Similarly, there should also be some difficulty in ranking the project because the size of investment is not considered. So, here if the two projects are giving the identical NPV, then size of investment should be considered because it is a relative term. The NPV available on some investment can not be a better indicator if the size of investment is not compared. So, this problem is very well rectified by another method that I am going to take up, is known as the profitability index. What is profitability index? It is the index which measures the present value of future expected cash flows and the initial amount invested in a project. So, this is a ratio, this is a index where the PV of future cash flow would be compared against the initial investment. So, any future cash flow which is more than the initial investment would reflect a PI greater than 1, and if the initial investment is more than the present value of future cash flow, naturally the index would be lower than 1, and hence the project should not be acceptable to the management. So, here numerator is giving us the present value of future cash flows and the denominator is reflecting the figure of initial investment outlay. Let us see with the example that we have used in order to calculate the net present value. So, I hope the process is clear to you. These are the cash inflow from the project A and project B, and the initial investment is 1,20,000. The process of calculating the present value of cash flow is giving us the 1,31,260 from machine A, 1,29,340 from machine B. Let us see how the PI would be calculated. So, it is future value, so it is present value of future cash inflows divided by the initial investment. So, 1,31,260 divided by 1,20,000 will give us the profitability index as 1.094, whereas if we use the same formula for finding out the profitability index from the project B, it is 1,29,340 divided by 1,20,000, and here PI is 1.078. Had it been the choice of management to consider both the projects, if there were no capital rationing, management was in a position to select both the projects because both of these machines are giving a profitability index which is greater than 1. That means, both the projects in itself are profitable and could be selected by the management, but if it is to be decided which one is better, then an index of 1.094 is better than the index of 1.078. So, what is the answer? Machine A or machine B? It is the machine A which has the higher profitability index as compared to machine B. I hope you have understood why PI is deployed for evaluating any projects, because in the first case, in the case of NPV, we were considering the absolute amount of NPV, that is 11,260 was compared against the 9,340 that is coming from the second machine, but in this case we are going to consider the numerator, that is the future value of cash inflow with the size of investment, and we get a different parameter to look at the projects and their profitability. I hope the process is clear and the logic why we are going for profitability index is also clear. Let us look at the merit of PI as the evaluation technique. The one merit is absolutely obvious to all of us, since it is using the process of discounting. It is considering the time value of money principle, hence fully doing justice with the pattern of getting the inflows and also the time in which the profit or the cash flow is available. It is helping us to rank the projects, and management are in a clear cut position which project is better out of the available set of projects. It is very good in capital rationing. What is capital rationing? Let me give you a quick definition of capital rationing. It is a process which is used by the management when there is a rationing of the fund. Like if the management is giving us say only 10 lakh rupees and we have to use our fund in such a manner that all the projects which are more profitable should be considered by the management. So, on the basis of PI, we can provide the rank 1, rank 2, rank 3 to all the project in question. So, that is how it is helping the company in total funds and the optimum utilization of these funds. And it considers all cash flow, unlike the payback period method where the cash flow generated beyond payback period method is completely ignored. Demerit of profitability indexes, it often ignores the scale of the projects and the cash flows are merely estimates. Whether it is outflow or inflow, the estimates may not be accurate, keeping in mind the future uncertainties. It sometimes may not give us a good result for the mutually exclusive projects, which is possible in case of NPV. The selection of discount rate, that is the hurdle rate, it is again a subjective matter and it is subject to dynamism, where it will keep on changing when the pattern of financing is changing in a firm. And all the capital budgeting techniques are quite introvert and their orientation is inward, whereas there are so many external factors which might have their bearing on the selection of capital budgeting projects. All these things are ignored under the profitability index method and somehow in other methods. This was all about the discounted cash flow technique, where we have discussed the net present value method, profitability index method. I hope the process of discounting the cash flows and then comparing it with the cash outflow is clear to everyone, and of course, the logic behind should also be clear, and then only we would suggest anyone, any finance manager to use these techniques whenever they are going for a risky proposition, whether to select a project or to reject a project. So, with this we have come to an end with the two very important techniques of evaluating the project and guiding the manager towards the selection or rejection of the projects. Thank you.